Welcome to this explainer. We're going to jump right in today and break down exactly how market volatility is literally being transformed into a self-reinforcing wealth engine. And we're tracking this all the way from billionaires down to your own personal portfolio. We're going to look at the exact mechanics that top-tier CFOs are using at the highest levels of corporate treasuries and translate that into a framework where you can start implementing step 4 of the runtime. Ultimately, this is all about turning market chaos into your advantage and becoming your own individual central bank.
Okay, let's kick things off with a pretty famous, hard-hitting declaration from Michael Saylor. He's the guy who completely transformed his enterprise software company into a massive Bitcoin acquisition vehicle. For years, his absolute golden rule, the one he repeated in countless interviews, was to never, ever sell your Bitcoin. I mean, hold on to it like your life depends on it, right?
But, well, this raises a fascinating contradiction that has the market totally buzzing right now. If his golden rule is to never ever sell, why did Strategy, his company, just offload $2.5 million worth of it? This is their first sale since 2022, and let me tell you, it caught a lot of people completely off guard.
Let's dive in and figure out why. Section 1. The Autopoietic Money Engine.
To truly understand the corporate hack Strategy is pulling off, we've got to look at the philosophical foundation of the asset they're hoarding. During a recent congressional hearing with Elizabeth Warren, it was brilliantly pointed out that Bitcoin represents a totally new foundation. Why? Because it replaces human committees with unfeeling, incorruptible math. There's no CEO, there's no board of directors, and crucially, there's no emergency loan committee that can unilaterally change the rules or debase the supply when the system gets stressed. It is essentially an escape hatch from the traditional system.
Now, this brings us to a super interesting biological term, autopoiesis. It basically means a system that creates and maintains its own internal structure automatically. Think of how DNA governs a living cell, right? Taking in resources, assembling them internally, and reproducing structure. In the financial world, Bitcoin perfectly satisfies all the necessary conditions of an autopoietic system thanks to its fixed protocol, absolute scarcity, and path-dependent monetary memory.
And this creates a fascinating Trojan horse contrast. Just think about it. While traditional fiat money relies on chaotic human loan committees, constant restructuring under stress, and shifting political agendas, Bitcoin acts as a globally neutral autopoietic protocol. It just ticks away, producing blocks, completely agnostic to whatever human beings happen to be panicking about on any given day.
This mathematical neutrality is actually so profound that we're seeing it play out on the global geopolitical stage. For instance, nations facing deep geopolitical tension, like Iran, are reportedly developing insurance frameworks, like the Hormuz Safe Initiative, settled entirely in Bitcoin. The goal here is to secure shipping routes completely outside the traditional dollar-denominated system. So regardless of the politics involved, this serves as a real-time stress test of Bitcoin functioning as a completely neutral settlement asset, one that no single government can freeze or seize.
All right, with that rock-solid foundation understood, let's move to Section 2, Strategy's Master Playbook.
The absolute crucial point for CFOs and investors studying this is the sheer scale. Strategy has accumulated over 843,000 Bitcoin. That gives this single company ownership of roughly 3.9% of all the Bitcoin that will ever exist. They are basically borrowing capital at a fixed cost and using it to hoard this pristine, autopoietic asset that they believe will appreciate way faster than their cost of debt.
Which brings us right back to our opening mystery. Saylor didn't break his golden rule because he lost faith. No way. The 32 Bitcoin sale was a highly deliberate financial engineering move. They used specific lot accounting for strategic tax loss harvesting and to help fund the dividends of their preferred stock. Basically, they sold a tiny fraction of a percent today to ensure the health of the corporate machine that allows them to acquire massively more Bitcoin tomorrow. It's a masterclass.
Which leads us perfectly into Section 3, Stripping the Volatility.
So how do they actually pull this off? Well, Strategy has effectively split their treasury into tranches. They realize the market for people who want a safe 10% yield is like 100 times bigger than the market for people willing to stomach massive 40% volatility swings. So their preferred stock, STRC, gives investors a safe, damped 8% yield for those wanting digital credit. Meanwhile, they literally chop off all that excess risk and return, passing it directly to the MSTR common stockholders. This gives those common holders amplified, high-volatility Bitcoin returns.
2.3%. This number is absolutely staggering. It is Strategy's break-even annual recurring revenue metric, the magic number.
It means that if the price of Bitcoin grows by a mere 2.3% a year, the company can fund its dividends forever without ever having to sell another share of stock. And even if Bitcoin doesn't grow at all, they still have a 43-year runway. That is the true power of their financial engineering.
Let's bring this all home. Section 4. The micro application, the recycling protocol.
So how do we take this massive corporate strategy and shrink it down for you? Well, this beta-weighted risk profile acts as a sleek executive HUD for managing your personal wealth. You can architect your portfolio so that assets like the STRC Anchor and Plasma Yield clusters completely dominate the variance. Roughly 75% of this portfolio trades like Bitcoin, but it's deliberately structured to strip out those heart-stopping drops.
You can visualize this using the wealth tree analogy. It's kind of like a giant puzzle, but when it clicks, it's brilliant. In this model, your STRC preferred stock acts as the sturdy trunk, which is drought-resistant. It pays out fruit in the form of a cash yield. The absolutely critical rule here is that you never auto-reinvest that fruit back into decaying instruments. Instead, you intentionally funnel that cash down into the solid roots of pure spot Bitcoin.
The actual text of the recycling protocol from our source framework proves that this isn't just theory. This is a tangible, mechanical framework you can conceptualize and run inside your very own brokerage account to capture yield and mechanically convert it into pristine assets. So let's look at how this builds into an actionable routine, what the source documents refer to as implementing step 4 of the runtime. Instead of trying to guess the market, you just follow these mechanical steps. You wait for your STRC to drop 5%, or for your cash dividends to hit $200. Then, you mechanically sweep that cash into spot Bitcoin. You run the whole shebang inside a tax-free account so there's zero friction. You are closing your spot Bitcoin gap without ever making a discretionary, emotional trade. So, as we wrap up this explainer, I want to leave you with a provocative question to chew on. If billionaires, macro institutions, and the smartest CFOs on the planet are systematically utilizing this exact mathematical hack to transform market volatility into a self-reinforcing wealth engine, what is stopping you from becoming your own individual central bank today? Thanks for joining me, and I'll catch you next time.